My honest and pure thoughts about technical analysis explained intro. Hey everyone, welcome back to the channel. If you're new here, I'm glad you found us. Today we're going to talk about something that many investors start out with: technical indicators. You've probably heard about them, seen them on stock charts, and maybe even tried using them yourself. In this video, I'm going to show you the 3 main indicators I used to use when I was starting out. I'll explain how they work and why I decided to stop using them. And don't worry, even if you're new to investing or don't know much about these indicators, I'll keep things simple and easy to understand. What are technical indicators? Before we dive in, let's first understand what technical indicators are. In simple terms, technical indicators are tools that investors use to help predict whether a stock will go up or down. They do this by looking at past price movements, patterns, and trends. But here's the thing. These indicators are mostly used by short-term traders, not long-term investors, and over time I've realized that for someone like me who's focused on long-term investing, they don't really help much. But let's look at the 3 main ones. Moving average. The first technical indicator is the moving average. A moving average helps us see the trend of a stock's price over time. Let me explain how it works. Imagine you're looking at a stock like Google. The moving average will show you the average price of the stock over a specific period, like 10 days. So if you choose a 10-day moving average, it means you're looking at the average price of Google stock over the last 10 days. Here's the trick. When the stock price goes above the moving average line, some traders might buy the stock, thinking it's going up. And when the stock price falls below the moving average, they might sell the stock, thinking it's going down. It sounds pretty simple, right? And in some cases it works. For example, if the price crosses above the moving average, it might go up. But the problem is, this strategy can be risky because it's always changing. The price might go up and then fall back down quickly, so you have to keep checking it every day. For long-term investors like me, this becomes too time-consuming. 2. Stochastic indicator. Next up is the stochastic indicator. This one looks at whether the stock is overbought or oversold. Let's break that down. When the price of a stock has been rising for a while, it might get too high and could be considered overbought. When the price has been falling for a while, it could be oversold. The stochastic indicator helps traders see when the stock price is reaching these points. This indicator has 2 lines, a buy line and a sell line. If the buy line crosses above the sell line, that could be a signal to buy the stock. And if the sell line crosses above the buy line, that could be a signal to sell. But again, while it might work sometimes, there's a big problem. The market can be unpredictable. Just because the stochastic indicator says it's time to buy doesn't mean the stock will always go up. And if you're trying to follow these signals constantly, you'll spend a lot of time in front of a computer. For long-term investors like me, it doesn't fit the strategy of just buying and holding good companies. MACD. Moving average convergence divergence. The 3rd technical indicator is the MACD, which stands for moving average convergence divergence. It's a fancy term, but don't worry, we'll keep it simple. The MACD shows the difference between 2 moving averages, a short-term moving average and a long-term moving average. When the 2 moving averages cross each other, the MACD gives a signal. If the short-term one crosses above the long-term one, it might be a signal to buy. If the short-term one crosses below the long-term one, it might be a signal to sell. It's a bit like the moving average, but with more complicated math behind it. And while it can sometimes show good buying or selling points, again, the same problem arises. You need to watch the stock all the time. If you're only focused on short-term movements, you might miss out on long-term gains. Why I stopped using these indicators. So now that you know how these indicators work, here's the important part. Why I stopped using them. They don't fit with long-term investing. The main reason I stopped using these technical indicators is that they don't really fit with my long-term investing strategy. When I first started, I thought they would help me make better decisions. But as I learned more about investing, I realized that successful investors like Warren Buffett don't focus on short-term trends. Instead, they focus on the value of the companies they invest in and hold on to them for a long time. Using technical indicators felt like trying to time the market, buying and selling over and over again, which is exhausting and often doesn't lead to better returns in the long run. Taxes can be a big issue. For people who live in countries with taxes on investments, technical trading can cause problems. For example, in Australia, every time you sell a stock, you have to pay taxes. And if you sell before holding a stock for a year, you pay more tax. So constantly buying and selling based on technical signals can result in a lot of taxes. But if you buy and hold stocks for the long term, you can pay less tax. For me, that made a big difference. It's better to focus on long-term investments and avoid paying unnecessary taxes. I found a better way to invest over time. I found that the best way to invest is to buy undervalued companies. That means companies that are priced lower than they're really worth. Then, instead of worrying about daily price changes, you just hold the stock and let it grow over time. This strategy is called buy and hold. You focus on companies with strong potential for growth and you let them do the work. Some of the best investors, like Warren Buffett, have made their fortunes by doing exactly this, buying a few great companies and holding them for years. Time and lifestyle. Lastly, I stopped using technical indicators because they take up too much time. Watching charts, checking stock prices, and trying to make decisions every day, that's not the kind of life I want to live. I'd rather focus on researching companies, making smart investments, and then letting them grow over time. I want my investing to be simple and stress-free. I don't want to feel like I'm working at a second job by constantly tracking stocks. Outro. So there you have it, the 3 main technical indicators and why I personally stopped using them. For long-term investors, focusing on the fundamentals of companies like their value, growth potential, and overall business health is a much better strategy. If you're also into long-term investing, I'd love to hear your thoughts on this. Do you use any technical indicators in your investing strategy? How do you balance them with long-term investing? Let me know in the comments below. And if you want to learn more about how I pick long-term investments, check out the resources in the description. Thanks for watching, and I'll see you in the next video. Don't forget to like, share, and subscribe if you found this video helpful.